couple of sessions, I think 3 sessions, 2 sessions and one panel discussion that we are awaiting post-lunch. May I now request CA Jinal Savla Madam to kindly escort our speaker, CA Binoy Parikh, and our WRC chairman, CA Ankit Rathi, as well on the dais. Can we have a huge round of applause for both of them? Our topic for this session is going to be structuring leverage buyouts, domestic versus cross-border, and I, CA Rudiesh Pankhania, Regional Council Member of WRC, feel immense pleasure to welcome all of you once again. Before we actually begin the session, may I request, since we have our chairman of the largest region of this institute, I request CA Ankit Bhai to kindly address our audience. Can we have a huge round of applause for CA Ankit Rathi?
Very good afternoon. It's indeed immense pleasure to be here with you all. At the outset, let me first recognize the presence of Honorable Vice Chairman, Western India Regional Council, Rahul Bhai Parikh, my Regional Council colleague, Rudiesh Pankhania. Let me also thanks to our today this session's faculty, Binoy Parikh ji. Sir, thank you so much. Despite of your so much busy schedule, you accept our invitation and being agreed to share your valuable knowledge with our participants. Let me also thanks to our today coordinator, Jinal Savla. Jinal Madam, thank you so much for always available for the institute and branch. Let me also recognize the presence of all other speakers and my dear friend Vijender Jain, the past secretary of Vasai branch. Friends, I will not take your much time. I just wish to update about the two things which I think really important. First one is obviously about the 38th regional conference. This time well in advance we already launched our 38th regional conference at Geo Convention Center on 23rd and 24th August. Friends, let me share you in this 2-day regional conference we are trying to cover various new topics. Let me share you about the topic, the role of the technology and the AI, how they affect the way we doing audit and the accounting, and the role of virtual CFO, what kind of offshore opportunity available, the sustainability and various other topics. I request each one of you please do register in the 30th regional conference, in which we anticipate more than 3,500 participants with the more than 100 exhibition stall and the, what I can say, the speakers and the panelists are also over more than hundreds. And the last request to each one of you, please do visit our Western India Regional Council website, in which we had tab My Role at the WIRC. I request each one of you, please do visit, and if you wish to write or if you wish to contribute as a coordinator, speaker and the author in our newsletter and in any publication house, please do write. Or if you wish, we at the region need to do any kind of program, seminar, conference or any other activity which is really important for our fraternity, please do let us know through our website or through phone number to any of our regional council member. With this, I again welcome you all in this M&A conclave. Thank you so much.
Thank you so much, Ankit Bhai. May I now request CA Jinal Savla Madam, who is going to be coordinating this session, to kindly introduce our speaker for the session, CA Binoy Parikh.
Thank you, sir. Thank you, Chairman, sir, and Rahul, sir. So, friends, today we have a learned speaker who is going to talk on structuring leverage buyouts, domestic and cross-border. So, friends, he has qualified his chartered accountancy in 2013, post that he has done his LLB, and his experience includes in M&A, transaction advisory, fund advisory, family settlements, and succession planning. He has done his articleship from GK Choksey. He has authored various articles in relation to M&A and succession planning on topics such as chapter on holding company structures published on Compendium on GAR published by Bombay Chartered Accountants Society, corporate gifts and etc. He has acted as a structuring and tax advisors to Eureka Forbes and Shapoorji Pallonji Group for sale of Eureka Forbes, acted as special advisor for PharmEasy on acquisition of Thyrocare Technologies, advisor to promoters of Global Insurance for its acquisition. He also holds the directorship and trusteeships in various companies, independent director of Sharda Energy and Minerals Limited, a listed company having market cap of USD 1 billion plus, recognized as the youngest independent director in Indian listed space by Times of India, independent director of Batley Boy Limited, a trustee of Amara Bachpan Trust, and so many other things he has done. So friends, let us listen our today's session from him. Over to you, sir. Thank you.
Before Sir starts his session, may I request Ankit Bhai to please present the memento to CA Binoy ji.
Hello. So good afternoon, everyone. I think the topic that we are having, the topic that we'll have over the next 45 minutes or so is structuring leverage buyouts, and I promise that I'll keep it light after a lunch session. I completely recognize that. And so what I've done is, rather than going too much into theory, I have evolved certain case studies which deals with various aspects. So without much ado, let me just start directly with the session. So first of all, what are leverage buyouts? Leverage buyouts are effectively a fancy term for buying out a target company using debt as an instrument or as a manner of funding the transaction. So the equity component is lesser, the debt component is more. Tata, of course, did it way back 2 decades back when it had acquired Tetley. Tata again had acquired Welspun Power 6-7 years back. Nirma had acquired Lafarge through leverage acquisition, and so on and so forth. Many examples, but there are various constraints in India insofar as LBOs are concerned, and we'll look at that. The constraints are mainly in the form of regulations which prohibit leverage buyouts in India. And therefore, are there ways around it? Are there structures around it? That will be the key topic for the next 45 minutes. So let's just talk about certain commercial considerations. So as I call it, it's the Creta interconnect. 1 is the commercials, RE is the regulations, T is the tax, and A is accounting, because the way India has evolved, it has really changed the landscape as to how you record a particular transaction and what impact it will have in the years to come, and we'll see certain examples of that. So first and foremost, commercial considerations. Any driver of a deal is neither the regulation nor a tax, but these are the commercial considerations which effectively drive a particular deal. So, like I said in the beginning, leverage buyout enables a particular company to acquire a much larger target than itself. So it's like a David versus Goliath scenario, but acquisition is through debt. The second consideration could be that you can ring fence the main operating company from leveraging its balance sheet. You could create a specific special purpose vehicle, and you can leverage that SPV so that the main operating company is leveraged. Of course, you have security and pledge over the assets, but effectively you are not leveraging a standalone balance sheet of an operating company. One of the other expectations is that there will be a high IRR expectation, and the reason is effectively you are leveraging a particular buyout. So your money on the table is lesser, banker's money is more, you pay a fixed interest payment on that, and therefore that's how you enhance your equity return. There are various repayment structures. The most prevalent in an LBO is a PIK structure, which is pay in kind structure. Now, what does it mean? Effectively, leverage buyouts result in a huge debt upfront. So you cannot have a regular kind of a repayment schedule, which effectively, let's say you have to pay every month, every quarter, etc. You cannot do that because the interest component will also be very high on that. So the pay in kind scenario effectively converts the interest payment component into a funded loan, And therefore, when you effectively pay, you will pay the interest, let's say after 5 years, along with the principal repayment, and the interest effectively will be paid along with the principal, and that's the pay in kind of a scenario. The other exit scenarios could be IPO, refinancing, or then strategic sale to another entity. The choice of debt funding becomes a very important factor because of various regulatory restrictions, and we'll see, and it is very intertwined with the commercial considerations. One of the most important aspects of an LBO, given its size, is that there is usually not one lender who's lending it. You have a group of lenders who are lending it, and therefore the arrangement between the creditors, called as the intercreditor arrangement, becomes very important. So what is the security? How do you enforce it? What is the definition of event of default? Could there be any special circumstances where you are waiving an event of default? What is the waterfall mechanism in case of, let's say, an IBC proceeding, or in case of a liquidation proceeding, insofar as the creditors are concerned? Then you have lender covenants which impact the operations of the target entity and even the parent company who's taking the debt. For example, in many of the mergers, demerger schemes, disposal of assets that we do, effectively you always need a lender approval prior to initiating anything. So lender covenants become very important when you are negotiating a leverage buyout. Coming to the regulatory considerations, first and foremost, the main reason why leverage buyouts are not too much prevalent in India, it's because there are restrictions on bank financing or LBO. So there is a restriction which says that a bank can only finance a promoter's contribution if it is for productive purposes. Now, typically they say that any acquisition of shares does not really fall within the definition of productive purposes, and therefore bank is typically handicapped by financing it. But are there ways around it? Are there any softer language in the agreements that can be sort of looked at? We'll see as we move forward. The second is, can you borrow from foreign lenders under the ECB rules? Certainly you can, but there are again two major conditions around this, and we'll see that. First is the minimum average maturity period. So if it is, let's say, for working capital or general corporate purposes, the minimum average maturity could range from 7 years to 10 years, from 5 years. 5 years if it is a foreign equity holder, 7 years if it is for a particular purpose, 10 years if it is even more. So the point is that these minimum average maturity periods are too high to start with insofar as ECB is concerned. Second key aspect is the end-use restrictions. So one of the end-use restriction in an ECB is that it cannot be used for investment in capital market. Now, what is a capital market is a fuzzy area. It's not a defined term, neither under the RBI regulations nor under the SEBI regulations. And typically, lawyers have taken a view that any investment which involves any intercompany sort of an investment, that becomes a capital market if there are shares and securities involved. The third is FOCC, which is foreign owned and controlled company. Effectively, a company which is owned by a foreign shareholder and controlled by a foreign shareholder, it cannot borrow domestically to acquire any other company. So again, an FOCC, I think Geenal was mentioning about acquisition of Thyrocare. So, PharmEasy looks like an Indian company, but it's an FOCC. So it cannot borrow. It had to raise funds from abroad through private equity, and then it had acquired Thyrocare. But there is some leeway where portfolio investors can invest in, let's say, high yield bonds, let's say through a non-convertible debenture. So last year we had advised on this particular structure where Shapurji Palanji had raised about 14,000 crores through high yield 18.75% interest bonds to do various other things, including certain acquisitions and refinancing. So this NCD route becomes a very important route where you cannot follow and comply with the ECB norms. Again, inbound and outbound acquisitions has its own sets of challenges, and I'll just demonstrate some in the next 2 slides with respect to pledge of assets, with respect to guarantee, and with respect to each of these aspects with respect to inbound and outbound. Companies Act, there is obviously section 67 subsection 2, which says that a company cannot lend to any person who in turn acquires its own shares. So the restriction under Companies Act obviously is applicable to public companies, so listed, unlisted public companies, not private companies, but lending for acquisition of its own shares is not generally permissible under the Companies Act. From a tax perspective, and the reason why I've clubbed tax and accounting together is because of a particular aspect relating to post-acquisition structuring, and we'll see one example of that. Interest deductibility, whether interest, the loan which is taken, interest on that, whether that is tax deductible or not, is always a question and a high matter of litigation under 36(1)(3). Now you obviously have thin capitalization rules. 94B prohibits or disallows any interest in excess of 30% of the EBITDA. That is disallowed if the loan is taken from an associated enterprise, or if an associated enterprise has impliedly guaranteed that loan, even if it is from a third party. This is very important, the fourth bullet, and like I said, that's why the accounting is a key over here. And I'll give you two examples of this. So Ind AS 109 deals with financial assets and financial liabilities. Annexure D to Ind AS 109 talks about the fact that whenever there is an extinguishment of a financial liability and a new instrument is issued in lieu of that, this typically happens in a distress scenario where the creditor's arrangements are being relooked at. In that case, what happens is that the financial, so let's say if I have a loan of 100, I'm issuing preference shares of 100, face value 100. Ordinarily, one would think that there should not be any balance sheet or a P&L impact had it been ICAP. But this Appendix D to Ind AS 109 provides that you have to record the fair value of the new instrument issued. So the preference shares face value could be 100, but the fair value of it, depending on the underlying capacity of the borrower, could be, let's say, 10 rupees. Now you are extinguishing a liability of 100. You are issuing preference shares and recording it at 10. The 90 gets credited to P&L. Now, ordinarily, can that be considered as a write back of loan because it is routed through P&L? If you have not adopted for a lower corporate tax rate, could there be MAT impact on that? All these questions comes because of Ind AS 109, and that's why it's very intertwined with the tax aspects. Ind AS 103, how do you account for a particular transaction? Will it result in particular recognition of intangibles? What about amortization of that? All those aspects will be dealt in a particular case study as we move on. Last but not the least, transactions will obviously entail transaction costs in terms of stamp duty, and whenever there is a merger or a demerger which is involved, the transaction cost could go very high. So for example, for long time, Maharashtra had a cap of 25 crores for mergers and demergers. Suddenly during COVID, it got doubled and it is 50 crores. And in one of the cases, we had merged, I think, some 10 real estate companies into one. We ended up paying 50 crores. So the transaction costs are too high, and we'll look at a couple of examples dealing with it. Now I know this is a very busy slide, and especially after lunch, it's not my intent to go through each and everything. But this is just to highlight, how much complex is it whenever there is a cross-border pledge of assets which is created, both for inbound acquisition and outbound acquisition. So let me give you an example. So the first example is that whenever an Indian company has made an overseas investment, so the equity capital of the overseas company can be pledged with an Indian bank, Indian public financial institution, or an overseas lender. And the fund and non-fund based credit facilities can be obtained by a foreign company or an SDS. Now, the point over here is that it only provides for pledge of equity capital and not of non-equity capital. So that is the first implied restriction pursuant to this. Then you can have assets in India being pledged, that of the Indian company, that of a group company, that of a promoter director, in favor of anybody. But effectively, all these regulations are very liberalized, but there are certain misses which are not really covered in these transactions, and we'll see that. One of the key myths, for example, is that none of these regulations deal with pledge of security or pledge of assets when you raise debt from an FPI under the NCD route. What do you do then? So that is not covered either under the FEMA NDI rules, which deal with inbound investments, or ODI rules which deal with outbound investments. Similarly, you have restrictions on ECB. So for example, a promoter of a borrowing company which has availed ECB can pledge its Indian shares only if the only if the lender is to that particular company and not to any other group company. So like I said, I mean, it's a very, very busy slide and it's always case specific. But like I said, I mean, you have so many permutations and combinations, especially when a cross-border pledge is concerned, because from a FEMA perspective, pledge is considered as a transfer of shares at the time when you are creating a pledge. Similarly, guarantees, for example, any ICO, which is Indian company which has made an ODI in a foreign company, it can give a corporate performance guarantee as long as you have a control over that entity. Now, control now is defined to mean that it's not only ODI, but you need to have at least 10% shares in a foreign company. So you could have, let's say, a 9% equity and balance is funded by somebody else in the form of loan, etc. That wouldn't work from the perspective of giving a guarantee or a loan to this particular thing. And so on and so forth in relation to exports, imports, etc. But the idea of this slide is just to showcase as to how complex it can get when a pledge or a guarantee is involved. So coming to the first case study. This is effectively Nirma's acquisition of Lafarge back in 2016. So we have an Indian operating company, Nirma. Then it had a specific acquisition SPV as a wholly owned subsidiary. And then it had acquired the target company. The acquisition SPV was a vehicle to get the acquisition finance. What were the commercial considerations? Like I said, the first is ring fencing the operating company from leverage, therefore the SPV, and acquisition SPV with a PIK structure. Like I said, the loan repayment can be deferred until a couple of years, can facilitate the acquisition, because the third step, which is basically Indian acquisition SPV, folding into the target company, will fund effectively the repayment of debt. Regulatory considerations. First and foremost, bank finance in this particular transaction was not possible because, as I said, it has to be for working capital, general corporate purposes, or productive purposes. And therefore, is it possible, and I had an interesting conversation as a part of my transaction, that, is it possible for the Indian operating company to take a debt for general corporate purposes? I mean, let's say not the entire 100 rupees is pushed down into the acquisition SPV, but let's say 20 is retained for genuine general corporate purposes, 80 is then pushed down to the acquisition SPV. Can that be done in some form and manner? And there are some banks which are taking this view. There are some banks which are very conservative, which are not taking this view. So the argument that at least I had put forth for consideration, and somewhere it worked, I guess, was that especially these kind of structures where ultimately the Indian acquisition SPV will be merged, reverse merged into the target company, and effectively the loan will be adequately be represented by the business. Can that be done? Because it's not only for the purposes of acquisition, I'm effectively then merging and collapsing over there. The fear is, and it's not written under the law, but the fear is that obviously any interpretation, anything to do with an interpretation, somebody has to take a call. RBI, the fear is that RBI may come heavily, and therefore any aggression in sort of interpretation is not favorably looked upon. The second aspect, and that's where accounting comes forth, is that upon merger, Indian acquisition SPV over here reverse merged with the target company. Target company effectively issued shares, its own shares, to the Indian operating company. Now the question over here is that here the acquirer is itself merging into the target, and therefore can you still record the assets of the target at fair value is the question. Now Ind AS 103 provides broadly two things. If it's a common control business combination, only pooling of interest method is available, no fair valuation is possible. The other method where you have unrelated parties merging or acquiring each other, you can do a fair valuation of assets if, let's say, the acquirer is the continuing entity. So let's say if the target had merged up into the acquisition SPV, then certainly Indian acquisition SPV is the acquirer. the target company can record its own assets at fair value. But here, due to various reasons, including certain rights which cannot be transferred, certain leases which cannot be transferred, the target company could not merge upwards, but the acquisition SPV had to merge downwards. So the question over here is that does Ind AS 103 permit fair valuation of the target company when effectively target company is the surviving entity? And the answer to that is yes, because under Ind AS reverse acquisition, there is a concept of reverse acquisition, and effectively it states that if effectively the target company was indeed acquired and due to certain reasons the acquirer then loses its identity pursuant to a reverse acquisition, then effectively you can record the assets of the target company at fair value. Now this then becomes a very important aspect, because let's say a company like Lafarge, which has its own brand, or let's say customer relationships in a B2B business or an EPC business, these intangible assets, so long as you have control over those intangible assets, effectively you can allocate your purchase price towards those intangible assets. So let me give you an example. Let's say you have 100 rupees of acquisition price, you have 60 rupees of tangible assets, and balance 40, you don't know what to do. So out of 40, I record intangibles of 30, and the residual 10 then gets recorded as goodwill. The advantage of this is that, as we all know, section 32 was amended many years back, and depreciation or amortization on goodwill was not permitted, or it was, the plug hole was really low. So over here, can you then claim an amortization on the intangibles which are recorded? The answer seems to be yes, because what was plugged was only amortization on goodwill and not amortization on intangibles. And therefore, Ind AS 103 enables you to do that. Had it been an IGAAP accounting, it would not have been possible. There is a linked accounting issue over here. So one is, let's say you have a brand. Now that brand could possibly, you cannot determine a particular life of that brand. If it is perpetual, let's say the brand is long running, then one can take a situation or a stand in Ind AS that the life is indeterminate, and therefore you really don't really need to amortize it in the books because I cannot determine a life. However, in let's say particular rights, let's say which are surviving for 10 years, then in the books, by recording a huge intangible, in the books you will obviously have a charge in the P&L, and therefore it will hit your book EPS. This is more relevant for listed entities where the EPS suddenly goes down on recording of a very high intangible. Process risk, of course, you have an NCLT process which takes about 7-8 months, and you have a CCI approval which can go in parallel. So there is a process risk, but a manageable risk. Insofar as tax and fiscal considerations are concerned, like I said, merger obviously is tax neutral. Interest deductibility under 36(1)(3), whether it is for furtherance of business, can that be argued? In many cases, yes, it has been argued that if I'm acquiring a connected business and if I'm using that debt, effectively that interest deduction should be deductible. Amortization of intangibles versus goodwill, we discussed. Intangibles can be amortized, goodwill cannot be. If the intangibles are also amortized for the purposes of books, it will hit the book EPS. Last part, stamp duty. In any reverse merger, what happens is that in Maharashtra, for example, when a wholly owned subsidiary merges upwards, there is no stamp duty because there is no issuance of shares. However, when there is a collapse, effectively the existing shares are getting cancelled and you are issuing new shares. So consider a scenario where you have 1,000 crores of shares which are being issued, 4,000 crores of debt which is being infused. So one will unnecessarily end up paying, let's say, 0.7% of that 1,000 crores, which is the net book value of the acquisition SPV, as stamp duty. And therefore, the idea over here to highlight over here is that while reverse acquisition may have a lot of benefits, the fiscal cost over here may become very important when you are analyzing a particular structure. Moving on. So this is a case where effectively the acquirer company is in a tight liquidity market, and therefore they are unwilling to really pay any cash upfront. But the seller shareholders effectively want the cash upfront because they are also in the same illiquid market, and therefore they want it upfront. So can it be structured in a two-step process? The first is that the seller shareholders sell the shares. The partial consideration of that is in the form of cash, and balance is in the form of a debt instrument. Effectively, then the selling company becomes a wholly owned subsidiary of the acquirer company, and then I simply hold up the VOS into the acquirer company. Coming to the tax considerations first, and I'll pick up the regulations. The first is, while it facilitates a deal consummation because the seller shareholders are indeed getting partial cash, they are also getting a debt instrument. Now, I think as Girish was mentioning, I attended towards the last part of the session, but it is effectively like a deferred consideration, and therefore even if the consideration is paid later, because the consideration is ascertained upfront, effectively it will be taxed upfront in the hands of the seller. So sellers could be out of pocket if this sort of a structure is entered into. From a regulatory perspective, there is obviously a risk to the seller because they are then trusting the acquirer that the acquirer will be able to service the debt as and when it comes. But for the acquirer, it again makes sense because the interest paid on the acquisition could be tax deductible. From an Ind AS perspective, we discussed the aspect of intangibles, but can it be recorded at fair value? Because at the time of merger, effectively it is a wholly owned subsidiary. And therefore, if it is a wholly owned subsidiary, can it be considered as a common control transaction, or an acquisition method of accounting can still apply, is the question. So there is a concept of transitory control over here, which basically says that before and after the business combination, if the set of shareholders controlling that entity are different, then it could be considered to be a non-common control transaction because of the transitory control. Because at the point of origin, seller shareholders were controlling Selling-Co. At the point of destination, it will be the acquirer company. So here there is a transition from the point of origin to the point of destination. And therefore, is there a way to record intangibles? The answer is certainly yes. And sharing a practical example over here. So 2 years back, when we had advised on the Eureka Forbes acquisition, it was held by Shapurji. Then it got split. Effectively, Shapurji and the public shareholders held the exact same shareholding when the demerger happened, and they held Eureka Forbes directly. After that, Advent, which is a private equity, they acquired shares from Shapurji, and the stand which was taken is that the demerger, the delinking of Shapurji from the Shapurji group to a parallel mirror image demerged company, and the entry of Advent is a concept of transitory control, even though the scheme didn't provide for Advent's acquisition because it's a demerger. So that transitory control concept was embedded, as a result of which, and it's public knowledge so I can share, the Eureka Forbes brand was recorded at a mammoth value of 4,000 crores in the books. 400 crores was residual goodwill, and it didn't have much net book value. So effectively, I suppose they'll be claiming a tax amortization on the brand. So this concept of transitory control becomes all the more important insofar as Ind AS is concerned. Process risk, of course, NCLT and CCI approval, especially when they are in the same business or they are exceeding a certain threshold. Moving on. So in case study 2A, we saw that the sellers will go out of pocket because they are being issued a debt instrument. Is there a way we can plug this so that there is no scenario where the sellers go out of pocket? It will be a scenario where the taxation is deferred as and when the consideration is paid. So can that be looked at? So here is a scenario where the selling company effectively merges with the acquirer company. Acquirer company knows that it has to pay for it, but it cannot issue a debt instrument because otherwise it will be a non-tax neutral merger. It cannot issue equity shares because otherwise how do you redeem it? So therefore, the only option that remains is a non-convertible redeemable preference shares. The idea over here is that unless and until the preference shares are redeemed, effectively you don't end up paying taxes on that. Of course, when the preference shares are redeemed, the shareholders will end up paying 20% tax, the selling shareholders, but they are not out of pocket on day zero. There is an inherent risk to the sellers over here also. What is that risk? The risk is because of Companies Act. Companies Act provides that the redemption of preference shares can only be out of profit or fresh issue of shares. Now, what happens if there are no adequate profits at the time of redemption and the promoter doesn't want to bring in fresh funds? That is a commercial risk which the sellers usually take, but it is hedged by effectively, you could have an optionality clause with the promoters that if the company fails to redeem the preference shares, I'll have a put option on the promoters effectively to say that the promoters will buy me out, and in an event of default, the promoters will be considered as defaulters. So there are inherent optionality clauses which are built into such kind of structures. This structure may not be viable for foreign shareholders because what FEMA permits is issuance of equity shares, and preference shares are considered as ECB. And therefore, you need an RBI approval if the seller shareholders are non-resident. So over here, effectively, it may not be viable for foreign shareholders, although there have been cases, and these are public listed companies, so I can share. There have been 3 cases which I know of, and one was a recent one, Wipro, Alembic, and Sterlite Technologies. It had provided for a mechanism of issuance of preference shares, and the preference shares were not directly issued, but they were parked with an onshore trustee. Effectively, what it does is that insofar as the company issuing it and insofar as the non-resident is concerned, there is no transaction. The link is broken because of the presence of an onshore trustee. And therefore, what effectively it means is that when the onshore trustee then sells, then the cash proceeds can be remitted back to the non-resident. But it was parked and it was provided in the scheme. There was a change in law in between. Now it is much more difficult to do that, but Alembic still did that. Like I said, the disadvantage over here, as compared to the earlier option where you are merging a wholly owned subsidiary into the holding company, the disadvantage could be a stamp duty value. Because what is happening over here is that the selling company is directly merging with the acquirer company and issuing shares. So therefore, there could be a huge stamp duty value, stamp duty implication on this. The question is, however, whether it will be the net book value of the seller share selling company, or would it be the underlying deal value? Because there could be a huge difference between the two. The position, at least in Maharashtra, that we've seen is that if the transferor company is an unlisted company, then it has to be restricted to the net book value and not the underlying fair market value. Moving on, this is an interesting structure, a variant of which we'd worked on. So we have an Indian company at the top. It has a legacy UAE company. It has now the Indian company has a particular identified business which it ultimately wants to have a new investor, which is the overseas investor, to invest. Now the question, there are certain commercial considerations over here. The overseas investor does not want to enter India at all. He doesn't want to incorporate a company, fund it through FDI, nothing. He doesn't want to enter India, and therefore direct investment into the India company is not possible. Similarly, if I drop it down to a wholly owned subsidiary and the overseas investor comes over here, not possible because he's not willing to come into India. So then the question then is that but the business is such that it has to remain in India because it's a business transfer. I cannot transfer it to a person resident outside India directly. So there needs to be an Indian company. And that is where you see Nuco at the bottom of the chart. So Nuco over here is incorporated by a Dubai company. Why? Because the overseas companies will only come in Dubai or a foreign jurisdiction. We had identified Dubai for this purposes. And therefore, the structure ultimately what it looked like is that legacy UAE company incorporates a Nuco because again, overseas investors wouldn't directly come to the legacy UAE company level because it has various legacies. Nuco Dubai incorporates Nuco India. Overseas investor comes in Nuco Dubai by way of purchase of shares of Nuco Dubai from legacy UAE company. So effectively, it's an indirect sort of a transfer insofar as Nuco Dubai is concerned. Now, there are various interesting interpretations which we had encountered over here. First is that is it permissible under the Companies Act, or is it prohibited? Is it permitted under the FDI rules, because now two level, or outbound rules, because now ODI FDI structure is permissible if it is up to 2 layers? So therefore, yes, because legacy UAE forms the first layer, Nuco Dubai forms, sorry, the first from a Companies Act. Legacy UAE is excluded because it's a wholly owned subsidiary. You have Nuco as the first layer, and then you have Nuco India as the second layer. So it's permitted. Round tripping permissible? Yes, again, because it's not exceeding 2 layers. How do you service the debt at the Nuco level if it takes? It will obviously be through certain dividends, royalty, management fees, etc., paid by Nuco India to Nuco Dubai. But these are regulatory provisions which we could sort of solve very easily. The key question was what happens in a tax scenario, because tax becomes very interesting way. What is happening is that overseas investors are effectively buying shares of Nuco Dubai from another UAE company. Nuco Dubai's only asset is Nuco India, and therefore obviously it derives substantially the entire value from India. Now the question over here is that sure, under Section 9, the entire value is derived from India, but under Article 13 of the India UAE DTAA, would it then fall under the residual provisions? Because here what is happening, UAE company is selling shares of another UAE company to an overseas investor, and therefore the alienation of shares is not that of an Indian company. And therefore can it fall under the residual clause, which provides that if you are not falling in any of the above, effectively the taxation is shifted back to the resident state, and therefore can I take a view that it will only be UAE where it is supposed to be taxed and not India? Technically, absolutely yes. But then there, of course, there is a principal purpose test. There is a GAR risk for indirect transfers. Sanofi, obviously Supreme Court blessed that, ultimately it reversed the SLP. But in Sanofi, there was a substance across various years. Here, if you see, it sort of lacks substance because the Dubai company is new, India company is new. However, like I said, the reason why I was stating the commercial considerations earlier could serve as a counterfactual scenario, because you have effectively an overseas investor who doesn't want to enter India. You have an overseas investor who doesn't want to enter into legacy UAE company. So I had no choice but to create a new company. And therefore, if I'm creating a new company on that, effectively, can I then develop the counterfactual scenario to justify my commercial consideration? The answer could be yes. The next scenario is again an interesting one. Sorry? Sure. Yeah. Hmm. Sorry, can you come back? Can you come back? Because overseas investor doesn't want to enter into the legacy UAE company. He doesn't want to come to India. No, indirectly. Yeah. So because ultimately, effectively, it's not 100% sale. It's a joint venture. So the Indian party is continuing over there, and therefore you need that level in that Nuco Dubai to continue with. So the next is basically, can there be an acquisition through a capital reduction for the reasons that, let's say, there is an incoming investor. The incoming investor acquisition finance is not possible by the incoming investor. It only is there. I mean, the distressed unlisted company can only take up the debt. So is it possible? The answer is yes. So let's say the incoming investor buys out the equity shares from the exiting shareholders. There is an acquisition finance by the unlisted company. Buyback is obviously not possible. Why? Because it wouldn't have the net worth. If it's a distressed company, it will have negative reserves. So buyback is not possible. Therefore, the only option that you effectively have is a capital reduction under Section 66 with an NCLT approval. If that be the case, then a possibility could be that acquisition finance is effectively funding the exit of the exiting shareholders. Is it possible in case where the non-residents are, if the exiting shareholders are non-residents? The answer is yes. Again, because it's an extinguishment of shares, it is considered as a transfer, and therefore, if it is considered as a transfer, the maximum consideration is restricted to a maximum permissible cap determined under the internationally accepted pricing methodology. What are the tax considerations? Here, the valuation becomes very important because for, let's say, exiting shareholders have two instruments. One is equity shares, one is CCPS. For CCPS, it is the actual arm's length pricing. For equity shares, however, and I think Girish was mentioning earlier, it's the Rule 11UA valuation for the purposes of 50CA because it's an extinguishment of shares. And therefore, the question arises is that if I do a capital reduction of certain equity shares at a value which is lower than the Rule 11-year valuation, say you could have a very high value of land, is it taxable in the hands of the exiting shareholders? The answer could unfortunately be yes, because of the valuation principle. Of course, you can have all these emotive arguments to say that it's an anti-avoidance provision and therefore you need not pay taxes on that, but really there is no non-technical answer to that tax shouldn't apply. What it does is, effectively, it's that there could be a scenario where the distressed company may have to withhold taxes if it's a non-resident. Now, if it withholds taxes on payment, which is the actual payment, but then a deemed capital gains tax liability comes on the exiting shareholders who are non-resident, then there is a risk on the Indian company itself to run a risk of a representative assessee, and therefore it can be taxed on non-withholding of taxes. Here, effectively, can it be said that the write back of loans, because it's a distressed company, the acquisition finance is partly used for exit, the balance is used for write-off or repayment of debt, and there could be a certain level of write back. Because of the amendment last year under 28(4), which provided that it could be in partly in cash, partly in kind, a write back of loan could still be triggered, and therefore it will be taxable. So therefore, we come to the next structure where can this 28(4) risk be avoided? The answer is yes. Let's say there is a distressed company, there is an acquired company, the transaction remains the same. But instead of a capital reduction, I effectively do a demerger of a division with unsustainable debt directly in the acquirer company. What this effectively does is that under Ind AS 103, fair value accounting is required if it's an unrelated transaction. Now, fair value of what? Fair value of assets and fair value of liability. And when I do a fair value of liability, only the sustainable portion of that debt will continue, and the unsustainable portion will directly be recorded as a capital reserve. And therefore, technically, there is no write back insofar as Ind AS 103 is concerned, or insofar as the P&L is concerned, because there's no write back. It's a direct balance sheet adjustment as a result of a demerger. In fact, I had mentioned at the beginning of the session that Ind AS 109 could also trigger. If you didn't do a direct balance sheet adjustment as a result of the merger, effectively it results in changing the terms of that financial liability, which under Ind AS 109 could be recharacterized, and therefore there could be 28(4) risk. Coming to the last one, and we discussed this briefly, because of various restrictions under ECB or acquisition financing of LBOs through bank finance, etc., can foreign portfolio investors effectively fund it through an NCD? The answer is yes. However, unlisted NCDs are not permitted to be used for investment in capital markets, and therefore, if you're making intra-group company investments, you will need a listed NCD. Security against NCDs, like I said, onshore versus offshore pledge. NDI rules don't provide for an offshore pledge. Onshore pledge with an onshore trustee could be possible. Normal FPI route has a concentration limit because not one FPI can fund more than 50%, so you need to have two unrelated FPIs. But there is an exception which says that under a route called as voluntary retention route, a single FPI can fund, provided it doesn't take out the money for 3 years. From a tax perspective, it's pretty straightforward. From a borrower's perspective, interest deductibility possible. Thin cap rules, of course, 30%. If the FPI's debt is backed by a guarantee from an associated enterprise, could be disallowed under 94B. But there is one last important perspective from an FPI perspective. And normal interest payment will obviously be taxed as interest in the hands of the investor. So therefore, can you effectively sell the NCDs by building in the interest cost in the trade, and therefore you convert the interest into capital gains? The answer could be yes, and therefore what happens is that, let's say in an India, Singapore, DTAA or anything else, because it's not alienation of shares, it's alienation of any instrument other than shares, the taxation goes back to the resident state, and therefore it is only taxed over there. You'll have to justify the substance as to why you converted your interest and into a capital gains. The borrower runs a risk of withholding of being an assessee in default or being an accommodating party under GAR because it facilitated such warehousing. So I think with that, the key takeaways, like I said, there are a lot of regulatory restrictions insofar as LBOs are concerned, especially under FEMA. Commercial considerations are critical. To establish substance of a particular transaction, tax becomes very critical. And therefore, LBOs, while they are driven by commercial objectives, because of a very tricky regulatory and tax scenario in India, it may really jeopardize a deal concept. So I think with that, I'll just stop. Thank you so much for patience.
Hello. I must say, can we have first of all your huge round of applause for Binoy ji? I think with the calmness and soothing, the way you explained everything with the examples, that was phenomenal. Thank you so much, Binoy ji, for this wonderful session. And we're going to start with the next session. Abitan ji is already here. The next session is on structuring venture, foreign and domestic capital entries in and exits from Indian assets. We'll be starting with a change of desk in next 2 minutes. Thank you so much. Thank you.